So this video is going to explain in as much detail as I possibly can how the Reserve Bank of Australia, where are we? Reserve Bank of Australia uses what we call domestic market operations, or DMOs, in order to influence the cash rate. You'll know that tomorrow is the first Tuesday of the month, because tomorrow is the 1st of August. So the Reserve Bank of Australia will be having their meeting tomorrow, so we'll probably see the cash rate stay at 1.5% tomorrow. But essentially this is the process that they follow when trying to, or when maintaining control of the cash rate. So the first thing we want to understand is that the cash rate is the rate of interest charged by the RBA to the banks. So we know that the RBA has two main roles basically. It's the banker to the banks and also a banker for the government. In the role as the banker to the banks, our banks, so we'll go with the NAB, ANZ, CBA, and we'll say Westpac, all have what we call exchange settlement accounts. So exchange settlement accounts that they hold with the RBA. And it's essentially a bank account that the NAB or ANZ or CBA or Westpac hold with the RBA. And within these exchange settlement accounts, they hold a residual or a certain amount of funds. The rest of the funds, it's only a very small amount that they hold with the exchange in their exchange settlement account. The rest of the funds they loan out in the form of mortgages to customers like you and I. So the exchange settlement account operates on a day-to-day basis. And the idea here is that if an individual needs to pay a bill and they're with the NAB, they have their money with the NAB. And if they're paying a bill to the customer from the ANZ, funds will transfer from the NAB through their exchange settlement account over to the ANZ in the overnight market and end up overnight with the recipient. The reason why these exchange settlement accounts are important is that these hold the funds in order to clear all of the day-to-day transactions from bank to bank. So in this situation here, if the NAB has a lot of transactions on a certain day, perhaps, I don't know, it's a lot of big sales on or something like that at Topshop, people are buying lots of stuff and all of those customers, I don't know, with NAB, whatever. So if there's a lot of transactions moving out of the NAB, perhaps the amount of funds that need to be transferred are greater than what's held in this exchange settlement account. And in that situation there, we've actually got the NAB has a shortage of funds in their exchange settlement account, and therefore in order to meet their balance requirements or their exchange requirements, they're going to have to borrow. And the rate of interest that they borrow at is at our cash rate, interest rate, which we know is 1.5%. So they'll borrow those funds from other banks. So other banks here, let's say the ANZ has a surplus in their account, perhaps they'll lend through the overnight market to NAB, and they'll charge a rate of interest of 1.5% per annum. Anyway, so getting to the point here in terms of our monetary policy stances, we know that if we increase the cash rate, then that should see a decrease in economic growth, probably a decrease in inflation, and the inverse is applied. So if the cash rate decreases, we should see an increase in GDP growth, and an increase in GDP growth, an increase in inflation. So in the overnight money market, so the Reserve Bank of Australia, in order to keep this cash rate of 1.5%, they deal in what we call the overnight money market. And what they do essentially is they buy and sell marketable securities. Marketable securities, this spelling's probably going to be wrong, essentially just bonds or pieces of paper that have a value. So what they do is they will sell buy and sell marketable securities in the money market in order to keep this cash rate at 1.5%. So we know that if the Reserve Bank of Australia wants to take an expansionary money supply, and that is they want to get GDP growth going and inflation increasing. So this would be expansionary, but they're going to increase the money supply. And in order to increase the money supply, what they do is they will buy securities. So they'll buy them from the banks. Oops, that spelling's terrible. So they buy the securities from the banks. So if the RBA buys a security from the ANZ, the security will go to the RBA and the cash will go through into the exchange settlement accounts of the banks. As a result, now in the exchange settlement accounts, there are more funds. So if there's more funds in the exchange settlements of the accounts of the banks, it's in their interests to loan those funds out. Actually, for when they have surplus funds, so when they have too many funds in their exchange settlement account, they get the cash rate minus 0.25%. So in this instance, they'll only get 1.25% payment for holding it in that account. So it's actually in their best interest to take whatever surplus funds they have in their exchange settlement account and loan it out in the form of mortgages. So in this instance here, the Reserve Bank of Australia has bought securities. So the securities now are held by the RBA. In return for those securities, they've paid money to the banks, so as a reward for giving them the securities. And now the banks have more money, so the money supply has increased. As a result, there's more money on the market, and we know that through supply and demand, if supply shifts out to the right, then interest rates will decrease. So in this instance here, what they've effectively done is by increasing the money supply, they have taken this expansionary monetary policy in order to reduce the cash rate. And by reducing the cash rate, the aim here is to get that inflation between 2 to 3%, and that will result due to this GDP increasing. Of course, the opposite also applies. So if the Reserve Bank of Australia wants to take a contractionary monetary policy stance, what they want to do is increase the cash rate. So they do that by selling securities. So in this instance, they're going to take those securities and they're going to sell them back to the banks. In return, the banks have to pay the RBA money. This has the effect of reducing the money supply, therefore increasing the cash rate because there's less money available in the market. So they increase the cash rate. It's passed on in the form of an increase in mortgage rates and lending rates by the banks, which should decrease GDP growth and decrease inflation, hopefully getting it between that 2 to 3% per annum. Hopefully all of this makes sense. We will go over this in class and do some practice. I'll chat to you then.